So Morgan's Stockbroking was actually founded in 1982 by Paul Porky Morgan. Porky was a great Queenslander, and he was actually instrumental in the formation of the Brisbane Broncos, so it's a rugby league team, so a little known fact, or maybe people were aware of that. Morgan's retains a strong Queensland presence, and following a couple of joint ventures over the years with ABN AMRO, people might remember that, and also RBS, we were known as RBS Morgan's. Morgan's Financial is now 100% Australian owned, and we have 60 branches, 60 offices across Australia, and we are the largest retail stockbroking and wealth management firm in Australia. So yeah, that's the Milton office here we established 13 years ago, and the business here is actually owned by management and staff. So of the 30 staff that we have, 15 of those people are shareholders. So we're very much, you know, owners and working in the business, and we care about what happens to our clients because we all, you know, have that very dedicated interest. So we have Milton here, we've got our wholly owned accounting firm, Strategic Business and Accounting Solutions, right next door, and of course the Ipswich office at Ipswich Springfield. So our financial service offering is client focused, and our aim is for you is to grow wealth, protect wealth and communicate. We pride ourselves in delivering excellent professional advice in all areas of investment, superannuation, personal insurance and accounting, tax and business services. So it's sort of like that one-stop shop, if you like, which works well with a few people here who have, you know, cross over between having their self-managed super fund looked after by Vanessa and Carolee, and their advisor looking after their share portfolio and other structuring, estate planning and so on. So tonight I'm pleased to introduce two of our team members. We have Carolee Rogers, who's the the manager of business services and tax with Strategic, and Pravesh Daya. Oh, there you are. Yeah. Sorry, they're not long distance classes. Pravesh, who is a private client advisor with Morgan's, and they're just going to give a bit of an update and see how any changes that are coming through now, what they might mean to you. So.
Stand up front. It's a bit of same but different. It's a bit of It's a bit of same but different in the sense that a lot of the economic policies and a lot of the legislation that was in place or introduced around budget night, it's still there. It's just a matter of enacting a lot of that sort of stuff. But I guess what is different is now we have a government with a majority, parliament. We have a much more reinvigorated government, and the reality is that while Australia is an island, it's not really an island, because we are still very, very much impacted by what happens overseas, which is why we say that economic realities will ultimately drive the market and therefore ultimately drive your investments. So what I'll start with is this Investment Watch. Investment Watch is a publication that we create on a monthly basis. And while, if anyone's interested in getting this copy, we can certainly arrange that. But what you'll notice about this particular one is the date. It says January 2019. Now, it may appear that January 2019 was a long time ago, and the information may have changed, maybe different, maybe updated. But in reality, like I said just a minute ago, is that it's in the sense same, but a little different. What I found when putting a lot of this content together was the information from January 2019 was still relevant today. But why that date's important is that you've got to realize, think back to what happened before January 2019. We had, thinking back to October 2018 through to December 2018, those of you who are invested in the market will know very well that your portfolios took a dive. We had one of the steepest, sharpest corrections in asset prices, both in the US and Australia, since the GFC. You've got to ask yourself why that was. And then what happened post-January 2019? So what happened post-January 2019 to March 2019 was we had a big uptick. So we have pretty much a V-shaped correction, a really sharp drop and a really sharp rise. And if you think about why that was, so why did we have a big correction coming into December 2018, sorry. Why we did that was because we had a number of unprecedented headwinds hitting the global markets and the Australian market. So from that perspective, globally we had Trump and China, like the US and China, saber rattling around tariffs. We had, in Europe, we had the Italian elections and the far-right parties gaining a lot of momentum. We had British exit or Brexit, which was a mess back then, it's still a mess now. We had the German economy, the PMI, which is the Purchasing Manufacturers Index, actually for about 6 months prior to that going into negative territory, actually declining. And that's really important from a European perspective, because if you think of Germany as the industrial hub of Europe, if they're starting to manufacture less product, they're actually then exporting less product, which means that what's happening economically in Europe is that they're not exporting as much to China particularly, and that has a tremendous impact. We also had the European central banks talking about rate rises.
Yeah.
What really pushed the markets down, though, was when the Americans started talking about rate rises. When the Federal Reserve started saying that due to the fiscal stimulus being the stuff that Trump introduced, the tax cuts, both corporate and personal tax cuts, that he introduced into the market in 2017 when he was elected, that started really picking up momentum. And then we had, and I'll show you it later on, we had this massive spike in the American markets. The Fed, the Reserve got really nervous and started saying things like, and I'm not sure if you remember the headlines, but it was Trump versus the Fed. In the sense that Trump's pushing the market higher with his stimulus packages, and the Feds are going, well, we need to pull back by increasing interest rates. That caused a huge amount of volatility, and that caused the American market to pull back. It caused our market to pull back. What we had happening in Australia was we had election uncertainty, we had Labor policies to contend with, thinking at the time that it was almost a certainty that the Labor government was coming in, and we had, if you remember the headlines, the worst housing correction in 70 years. So we had a lot of stuff happening. So now when you look from January 2019 to March 2019, and you think of, well, what's different? We still had the election uncertainty. We still had the housing downturn. We still had Brexit. We still had Trump. What was different, though, was the Fed over Christmas realized they pushed too hard and started talking about interest rate cuts, not rises. And that started flowing through our rhetoric as well. That, wait a minute, we've got inflation running way too low. We've got stagnant wages growth. We need lower interest rates. Hence today, the last meeting at the Reserve Bank, they quite almost categorically from the Reserve Bank perspective stated that we're going to get a rate cut today. And what we needed was to have the rate cut we got today, and we needed the banks to flow that through. Most banks have. NAB has come through with a full rate cut, CBA with a full rate cut of 25 points, ANZ has come back with 18 basis points. So predominantly they have. What that means, though, from our perspective, is that interest rates do tell a very, very interesting story. And when you think about what that story is, you're looking at liquidity in the market. You're looking at what does a government do to help push up the market, right? So what I'm going to talk about today is ultimately these 3 points. The first point is that we have strong equity valuations. But when you look at what bond markets are doing, you've got two distinctly different stories. You've got shares going really well and going up in value. And then when you look behind that value, you think, well, is it really that good? And on the other hand, you've got interest rates at record lows, right? So you've got both in America and in Australia particularly, I should say America particularly and Australia, you've got record low interest rates. When you look at the US, we are facing into this thing called the inverted yield curve. The inverted yield curve means that the long-term bond rates, when you're looking out 10 years, the long-term bond rates are lower than the short-term bond rates being 2 and 3 years. So if you look at the graph, you can picture the graph, you've got the long-term bond rates coming down that way, and you've got the short-term bond rates higher, so you've got a slope going downwards, an inverted yield curve. 80% of the time, that indicates a recession. Not all the time, but 80%, which is a pretty strong indicator. So you've got a situation where you think, well, okay, we've got strong equity valuations, we've got robust fundamentals. The first quarter GDP results from the American market was 3.2%, which is actually very good, and to expectations. So on one hand, you're saying, well, GDP in the US is looking really good. Corporate earnings are looking pretty good, not very good, but pretty good. Share prices are going up high. So we are saying, well, a recession is not imminent. But then when you look at bond rates, and you look at long-term versus short-term, you think, well, okay, we're almost 80% chance of having a recession. Who do you believe? What do you do? And that's why we're saying that to find a clear outlook is actually quite difficult. And what that leads to is incredible volatility. So you would have seen, what happened in the US with really big drops in the market, and then in Australia too, really big drops and then really big pickups as well. And that's the volatility. What we are saying, what our equity strategy team is saying, is that we remain cautious around equities. So we are in a way neutrally positioned on equities. So we remain cautious in equities, but there are some really, really good opportunities that come through as long as you are a nimble investor, being that you have kept some of your powder dry to take advantage of the opportunities that come through, because there are going to be some really strong opportunities in the market. It's just a question of being in the right time, the right place, and having the right outlook. So when I say that interest rates are telling a really interesting story, think of interest rates and to a lesser extent, a fiscal stimulus like tax cuts, infrastructure spend, but think of interest rates more so as a bit of a sugar hit. You get that sugar hit, like today we had a rate cut, the banks bounced, the market's going to go up for the next few days, and that's going to push equity prices up again. But what happens when we have too much sugar? It's not necessarily a healthy thing. So we think of it as a sugar hit. Is it really good for us? Perhaps not. When we look at the global credit environment, we need to think of that in terms of liquidity in the market. This is really interesting. I'm not sure how this came about, and I certainly would like to find out. Maybe live in interesting times. We certainly are living in interesting times, because there's no one alive, unless you know somebody who was alive back in the 1400s, there's no one alive now that has ever lived through the market environment that we have at the moment. We are living in abnormal times, in the sense we've never had the degree of market liquidity as we have at the moment. So why that is an issue is that because of the scale of the coordinated post-GFC monetary stimulus, what we did was, in reaction to the GFC, we started dropping interest rates. We went to, Japan went to zero, the US went to almost zero. We at 1.25 now, which is historically zero. We've only got 6 more shots of gunpowder left in our barrel before we're out of that stimulus eye as well. Because of that, we have pushed liquidity up to support stock values. We are now living in a low forever type environment where we expect interest rates to remain low, especially while employment is not going anywhere, and wage increases are not going anywhere, and inflation running at 1.75% is well below the RBA target of 2 to 3%. We don't see interest rates heading north at all. The problem with that is that it becomes a core driver. Low interest rates become a core driver to stock values. The core driver to a stock value, to a share price, should be earnings per share. Earnings per share is the economic contribution that company makes to the country's GDP. That's where the value of the company should lie, not in a hit from low interest rates creating more money in your pocket to spend, pushing up the share price, right? And that's where the risk is at the moment, is that we are having inflated share prices because of monetary and fiscal policy stimulus. So when you look at that, you think, well, okay, what does the future hold for us? Here's an interesting stat. Almost 80% of elections saw a price rise, or the average price rise, of 5.2% across the market in a 12-week period following an election. Anybody hazard a guess at what the current price jump has been on the ASX following the recent election? I'll give you a hint, it's more than 5.2%.
Yeah, it's gone up.
13.2%.
Wow.
it is quite significant compared to the historical average. Kind of shows you the mood of the electorate, as well as how bullish we can be on stock prices. But when you look at all of that, you've got to think, well, okay, how do we, like I said, Australia is not an island. We are an island, but not an island economically. We do have to consider what happens globally. We have to consider what happens in the three major blocks, being the US, China, and Europe. And those events certainly play a role in our stock valuations, and not so much our stock valuations, but our forecasting as to what we expect the market to do going forward. Any questions before I continue? Will, over? Okay. So, let's look at China first. As much as we, well, I'll speak personally, as much as I have a laugh at Donald Trump, and we think all sorts of things about him, we've got to understand where he's coming from. And I reluctantly say this, but he does make sense. You know, I'm not a supporter by any means, but it does make sense. What is the trade war about? The trade war is about, apart from ego and power, the trade war is about balance. All right? When we say balance, what do we mean? So look at these stats here, the trade weighted average. So I'm not talking about the trade weighted average is a combination of agriculture and non-agriculture, which are your economy just divided into two. What it means is that percentage represents the think of it as a basket of imports that's common amongst all economies. So all countries, all economies are going to import a similar, virtually same level, type of things, basket of product. That 2.4% represents the barriers to trade, whether it be tariffs, whether it be sanctions, whatever it is, it's a barrier to trade. What that is saying to us is that the US actually has the lowest level, the lowest barrier of trade, which means that it's most open to its economic partners to do business. China, on the other hand, is 4.4%. Australia is actually 4%. We've actually got more tariffs than what the US has. India is 7.6%. So in the press this week, Donald Trump talking about taxing everything that comes out of Mexico because they're not playing border games with him. That's going to really damage the Mexican economy, but whether it happens or not is yet to be seen. But he also singled out India. So that's his new sort of target, his new crosshairs, in the sense that he's saying, well, India should no longer be considered a developing nation, but a developed nation. Moving that status means you can actually add more tariffs to that particular country. When you look at the numbers, you think, well, okay, that seems reasonable from his point of view, because India is actually at 7.6% worth of tariffs or barriers to entry or barriers to trade against the US. The US is 2.4%. Why is China, though, in our headlines? Simply because of the size of the nation, or the size of the economy, second largest economy in the world. One of the biggest trading partner the US has. I don't have the numbers offhand, but I can tell you China exports a lot more to the US than what it imports. So China cannot afford to enter a trade war with the US. So you'd think rationality will take place at some point, which is why we say China is at the bargaining table, but they can't afford not to be, given how important the US is as an economy to them, right? So if we look at that, look at the moment, it's saber-rattling. Some people have a conspiracy view around them stalling until we get closer to the American elections, and all of a sudden we have a breakthrough, and that makes everyone look really good. But whatever the case is, China has to come to the table and protect its economy. I'll go down to this point here, is looking at our research and our forecast. The Morgan's view is that we expect China will continue to grow at 6.5% of its, which is its target. Keeping in mind that 5 years ago, not even 5 years ago, say 7 years ago, Chinese growth was above 10% per annum. So imagine GDP growth at above 10% per annum. It's phenomenal for a country that big, for an economy that big. Phenomenal for us, and at 6.5% is great for us as well, because we are a commodity-based economy. The more they grow, the more we sell, which is good for us. Now, What happened also in China, they've, between 2017 and late 2018, they had a 3-tranche stimulus package. Again, like everyone else, creating liquidity in the market, pushing up the market. But the difference between what they were doing is to prevent the market from really dropping and GDP dropping beyond what they could control. They pumped a lot of money into the market. They weren't trying to grow the economy, they were trying to stabilize the economy. What they're doing now, what China is doing now, is applying fiscal stimulus. So they've changed their strategy mix, and they're using a lot of fiscal stimulus, which is spending as well as something similar to tax cuts and so forth, to create liquidity. Again, good for us. So as long as they are spending, we are selling. So from that perspective, we like what China's doing. Talking about the US now, what's happening in the US at the moment is if you simply look at it at a macro level, that is, you ignore the fact that the US has got 2 distinct markets, being the Dow and the NASDAQ, both are very, very individual in their characteristics. At a macro level, US corporate growth is now moderating back to its long-term average as the one-off tax cut cycle starts to wind back. So what that is basically saying, in 2017, when Trump came into government, he introduced corporate and personal tax cuts. That was a fiscal stimulus, created a lot of liquidity. What it did, though, if you look at that, the blue line is earnings per share, the dark blue line is the S&P, the 500 index. What that did was push the stock market up, but what it didn't do is push the earnings per share up. Again, that sugar hit that I mentioned before. While you can have higher prices, your companies aren't necessarily doing any better. So that creates concern, that creates weakness, potential future weakness as well. Then as we spoke about just before, when towards the end of 2018, when the Fed started getting nervous, because again, you're looking at these sort of price rises. As the Fed started getting really nervous, we started seeing a pullback because interest rates came up, etc. We saw a pullback in asset prices, and that affected the American market tremendously, which also then affected ours, which is why we had that massive decline between October 2018 and December 2018. What we're seeing now is that if you look at the 10-year average, the price-earnings ratio, so from a historical perspective, the US is at 16.5 times earnings. 14.9 is the long-term average. 16.6 has been the average as it is at the moment, but 16.5 is currently where it's at the 5-year average. So in a nutshell, what we're saying is that the American market is expensive. So if you're looking at a portfolio positioning perspective, from a portfolio positioning perspective, the Australian, the US market is expensive, and therefore you want to consider what weighting your portfolio has to US. Considering that, what does the future look like? Do we expect, valuations to change? Right. So, before I talk about that, the other thing I want to mention, so I'd said 3 economic blocks, number 1 being China, number 2 being the US, number 3 being Europe. What's happening in Europe at the moment is interesting in the sense that Brexit is still a mess, more so than it was last year this time. The German PMI index is still tracking down, which means that Germany is still manufacturing. Manufacturing output from Germany is tracking down, which means that they are exporting less. The big contractors, or detractors I should say, to European economic growth has been Turkey and the UK. They have significantly dropped off in their exports to China. So again, from a portfolio perspective, what this sort of thing means for you is that where do you put your money? Do you put your money in Europe? Well, most commentators are now thinking that Europe is probably hasn't bottomed out yet. Equity prices in European economies are probably going to drop further. So that means, do we want to invest in Europe? Probably want to have an exposure to Europe, but you certainly wouldn't want to be overweight Europe. The US is somewhat expensive, but you certainly wouldn't want to not be in the US because they do turn very quickly. Australia equities are tracking high as well. Again, you don't want to be overweight Australian equities because, again, we are sort of pricey, but there are certainly strong opportunities in the Australian market. There are other factors involved in the Australian market, such as dividends and those sort of things, which I'll talk to in a minute. But when we look at those three economies, you've got to consider what's happening around the world. Other asset classes being alternative assets, private equity funds, that sort of thing. They tend to be uncorrelated to these major economies. So from an investment perspective, well worth considering your portfolio. And then of course interest rates and bonds. Again, we're tracking quite low on returns from bonds, and there's probably a greater risk in those markets, in the bond markets. Now, having said all of that, what we're doing now, what we're talking about now, is directly related to our election, in the sense that there's essentially two things that has to come forward post-election. Number one is that we do have a reinvigorated government, and we do have a softening economy, and we do have a softening stock market, and we have perhaps a fully valued stock market. So the government has to introduce policies that will drive the market forward. But the big thing here is capital investment. So in the run-up to the election, corporates favoured returning cash on the assumption that refundable franking credits were likely to go. Now, what that really meant is, if you remember, towards the end of last year, BHP, Rio Tinto, more recently Woolworths, from memory, CBA, all these companies that had large franking accounts, basically over the years, as tax rates had changed here and there, as they had retained profits and not paid out high levels of dividends, they had stored up all these franking credits, which they hadn't distributed out. So they had all these these credits sitting in the balance sheets. If we had to change a government, that would have been almost worthless, not totally worthless, but certainly a smaller sector of the market would have been able to use it, and therefore that asset would have lost value. So what these companies did in the lead up to the election was emptied out their franking accounts. For example, BHP, they had a two-tranche facility. The first one was a buyback. They were buying back stock at a significant loss or significant discount to the market price, but making up the difference by giving you a franked credit. So your actual return on your trade was about 22%, if you consider the tax benefit that was attached to it. Then they followed that up by paying you a special dividend of franked credits. So that was great for those people who held BHP stock, but the return on that investment was actually really good. Rio Tinto did something very similar. Woolworths, like I said, recently completed their transaction. The other thing that happened was, because of the economic backdrop, the uncertainty around the election, all that sort of stuff, there just was capital investment had dried up. And when that happens, the one thing that suffers is the ability of a company to generate profit. If you're not investing back into your company, you're paying it all out, you're not attracting new money into the company, the company's not going to grow. And you're not going to get the share price that you want if earnings per share if the share price being a factor of earnings per share and not a result of stimulus such as monetary policy or fiscal policy. So when you look at it from that perspective, we look at the Australian market and we go, well, okay, it's almost a mirror image of the US market. It's almost the same, right? So what you're looking at there is we've got Australian industrials around the 2018, which pulled back. We still had a very strong earnings per share above that, but then we saw, with all the election noise, we saw that earnings per share decline, and that's a factor of the fact that companies weren't reinvesting, they were paying dividends out, they weren't attracting new capital. We were just in this very, very stagnant type of situation until we knew what was happening with the government. Where we stand now, though, is also this, where our 10-year average is of price earnings ratio is 14.2. Where we're currently at is 15.2, and the maximum we really should be at is 16.2. So we're almost fully priced. On a price earnings ratio, we are almost fully priced. And that is because we've moved up on the back of interest rate cuts and the back of further fiscal stimulus. We haven't moved up because companies are actually doing better. So what we've got to look at is what companies we want to invest in, how their PE ratios look, what the dividend payouts are, and how they fit into your portfolio to make them a viable investment going forward, a less risky investment going forward. This is an interesting slide in the sense that it talks about where, on a 12-month forward-looking PE ratio, so we were to project 12 months out on a price-earnings ratio, how do we sit against long-term averages? Now the black line refers to your long-term averages. The only two sectors below your long-term average is housing, and that's because we've had a housing downturn. So housing-related stocks are below the long-term price-earnings average, and the other one is agriculture. One of the impacts that we need to consider is when you look at housing as an impact on the economy. When the housing market turns down, it's not just the housing market that turns down. You have what's called a wealth effect. And the wealth effect is simply how wealthy do people feel. Now, if you remember when the market was booming, people felt very wealthy, especially in Sydney and Melbourne. The house prices went through the roof. They're buying BMWs on borrowings from the house by using the house as security. People feel wealthy, they spend money on stuff. The housing market turns down, people don't feel so wealthy, they feel stressed and they feel under pressure, they stop buying stuff, which means that you're not buying your TVs, your fridges, stuff like your JB Hi-Fis are going to struggle a little bit. Harvey Norman's going to struggle a bit because of the wealth effect. People are not spending as much money. So what you do want is a robust housing market to have that wealth effect flow through the economy. What this suggests is that if the forecasts that we've predicted come true, or sit true, at circa 4% over the next 3 years, it is 7% short of the same point that it was 10 years ago. Really, what it's saying is that your portfolio is going to do 3% less than it did last year and the year before, if our forecasts ring true, that you're going to have about a 3% less return on your portfolio. And I guess one of the things we often talk about is in the post-GFC world, but remember in the 90s, you could make money no matter what you did. But post-GFC world, you have to, as an investor, expect a slightly lower return on your investments, and also be more vigilant around what you're investing in, and not be complacent because we've got more volatility, potentially lower returns, and yet opportunities in the market. So, how do we see policies coming through? This is probably the slide I like the best on its entire deck. It's post-election, now that we know who's in government, and we know what the policies look like, and we know how things, the political uncertainty is not there anymore. What do we see happening? So this part here, incremental tax reform, again, that's the fiscal stimulus that now the Morrison government is going to start introducing. So in tandem with our monetary policy, we're going to see this fiscal stuff come through, which will increase liquidity, help the property market up as much as it can, and therefore all those things that Carrie spoke about is going to help us. The $30,000 write-off, the tax rebate of $1,080 to middle income earners, etc. They're going to help stocks like your JB Hi-Fis of the world, very well-run company, Harvey Norman, AP Eagers, your car companies, Baby Bunting, and Wesfarmers. So these are your discretionary spends, and your discretionary spends look good when the market looks good. When the wealth effect is working in your favor, discretionary spends look good. Discretionary things being things like your JB Hi-Fis. You don't need to go and buy a television, but you do it because you're feeling wealthy. Your Wesfarmers, which I would consider to be more discretionary now that they've moved Coles on. Coles and Woolies are your staple stocks, your defensive stocks, which will always or should always do well regardless of the economic situation, given that you have to eat, whether the market's going down or not. Australian housing, this is a good one because of the first home loan deposit scheme and how that plays out. So effectively, that's going to bump up banking stocks. Banking stocks are sort of going through another resurgence at the moment, given today's rate cut, plus that sort of thing, which is going to push up the value of the amount of borrowing that occurs. Companies that may not do so well, like Genworth, for example. Genworth is the largest mortgage insurer, so anytime you have less than your 20% deposit and you need to get mortgage insurance, Genworth is probably going to be the provider. Despite the fact that Genworth may not benefit from this sort of policy, you know, their dividend payouts were, I've got to check now, but were in the vicinity around 9 to 10%. So again, whether or not you buy that stock, and whether or not it's good for your portfolio, it really comes down to your need for income and how you want to structure your portfolio. It's not to say losers are not going to be part of your portfolio, it's just to say that they're going to be under pressure because of the policy changes. Mortgage brokers, of course, they opted during the Royal Commission, unfairly so perhaps, retaining upfront and trailing commissions for at least 3 years. The government intends to put a review on into that whole sector by the ACCC in 3 years' time. But in the meantime, AFG, mortgage choice, you know, that's will benefit, and hopefully some sense comes into it. Because the contribution by mortgage brokers is great. It's a really good one. A lot of banks, you know, part of the whole thing was, you got to remember your big four banks still maintain the largest market share of loans done. But to get a true choice, you know, like Macquarie, for example, the big billboards Macquarie puts out there is in support of mortgage brokers. All of its lending is done by mortgage brokers. So having a mortgage broker to do a good comparison is really important. Private hospital providers, the big winners there, Medibank, NIB, Ramsay Healthcare. The reason being that the Labor government is talking about a 2% cap on its premiums. If the cost of running your business is greater than 2%, the company is going to be losing money and it's going to be impacting the share price. If, on the other hand, premiums are likely to rise faster, we forecast 3.3%, you want to hope that that's because the cost of running your business is increasing by 3.3%. But regardless of that, without a cap, at least you have a more market-friendly policy towards that sector. Healthcare. The budget includes provisions for diagnostic imaging services, primary care, re-indexing, and companies like Sonic, Helios, Integral Diagnostics will do quite well. Same with energy policy. If we are going to meet our Paris Agreement and have a renewable energy target of 20%, then the renewables will do really well. Now, obviously, your traditional contractors, there's still some uncertainty around the legislation around energy pricing, and that's probably a priority piece for the new government. But to get clarity around energy pricing, hence it's in the disadvantaged column. But if you are looking at renewables, then of course those companies will do quite well. In a nutshell, those are the major market initiatives that will impact your portfolio. Of course, Kerry spoke about superannuation and all the other things. I've got a director at the back there telling me to move to the camera. So look, from that perspective, as a summary to what we're talking about is what we have in the green, the amber, and the red. We have good accommodative monetary policy. We have good accommodative fiscal policy in Australia and globally. We do have robust global growth. And if China does the 6.5%, we're going to have high commodity prices and we've got more exports, which is great for us. US tax reform is on the cards again. The unfriendly stuff, this is on hold because the European central banks have put that on hold. The US is now not talking about increasing interest rates, but perhaps reducing it further. That's an issue. Trade protectionism, as I said to you before. Asset prices, again, we need American companies and Australian companies to increase their earnings per share. All the rest. Capital flight from emerging markets, that's always an interesting one because emerging markets do well when global interest rates are low because emerging markets borrow from economies of the world. And if emerging markets can borrow at a low rate, then they will do quite well. But there's always risks attached to emerging markets. They're very volatile. And you never really quite know. Especially if China does well, emerging markets do well, because they're great trading partners. The unknowns, well, that's, who knows? The UK might sort itself out or not. Potential US recession, like I said, the long-term bond yield, the inverted curve thing, that might happen or not, but it's worth keeping an eye on. Finally, what do we do? Be mindful that we're not going to have the fantastic returns in the immediate aftermath of the GFC when we were in strong recovery. We are now what's considered late cycle investing, and late cycle investing means that, like I said, our asset prices are sort of stretched, so we are getting in, if we're getting in for the first time, we're getting in at sort of the top of the market. It is late cycle investing. It is characterized by high degrees of volatility, which in its own right creates opportunity. Hence, be opportunistic. It's nice to have cash to to take advantage of opportunities. Don't always crystallize profits if you don't have to, but depends on your strategy, I suppose. We do have a high conviction list that we follow very closely. I'm happy to talk to anyone about that if needed, if wanted. Diversify internationally, because again, like I said, we're looking at major economies, and each economy has its own nuance which we can take advantage of. Certainly never write off the American market, because it does turn very quickly. And don't be complacent, because we are living in extraordinary times. Great, well done.
Thank you.
Any questions?